Hello, everybody. Welcome to our little virtual soiree that we do every week. So this is IMRG's retail weekly retail data show. It's actually written on the slide in front of me. What we do every week is we look at what's going on in e-commerce. So we have an index that we run and we get data in from retailers. Many of you indeed participate in it, and we benchmark how things are going. So we can show you whether things are going well or they're not going particularly well. And then we get some guests on to help us talk you through some of the stuff as well. And it's a bit of a special edition today because we've got a bit of a forecast for how performance is going to be for the rest of the year. So what we're going to be looking at today is week 2 of January, which is week commencing the 8th of January. Our index runs from a Sunday to a Saturday. So we'll show you how the year is starting and contextualize how that performance is going. And then we're starting to look at some channels, actually, and we're going to talk through direct mail, who uses it and what you can get out of it, etc. And then I'm going to look at budget, mid-tier and premium. So what is going on with those groups, right? Is the economic situation, is it forcing certain ones to do better than others? Have a think about what you reckon would happen there. And then I'll show you what we're actually tracking. And then we've got some guest perspectives to get some expectations about 2023, what you should be focusing on, some stuff that you could try, etc. And then we'll show you that market forecast, and it's got some categories forecasts in there as well. You can ask questions, obviously, because Zoom allows you to ask questions. So first bit then is to look at the second week of January. So like I said, this is week commencing the 8th, but we'll show you, a graph of a load of stuff on it anyway. But that's the latest week. So this is the performance of the online market over the last 12 months. So it goes back to the start of January 2022. And what you're seeing there is growth in revenue for online retailers. This is all of them combined. And what you see is it's been a pretty poor year for 2022. We did our review last year, so it was down 10% for the whole year. First time it's ever been negative. And, by far the worst, lowest growth rate that we've seen. And it's very rarely been into positive. And what you see there on the right-hand side are the first 2 weeks of January. And they don't look too different, really, do they, from what's been happening for quite a lot of the year. So it was down about 2% in that second week. But 2% down isn't that bad if you look at the rest of the year, rest of last year, sorry. But we are comparing against that gigantic drop, which was Q1 of 2021, which was comparing of 2022, sorry, which was comparing against massive growth from 2021 because of the lockdown skews and everything. So actually those declines that it's comparing against are pretty sharp declines. The one from last week was comparing against about 22% down from last year. So it fell 22% last year and it's fallen again 2%, right? So it doesn't look too bad given how bad things have been, but it's still, you really would expect over the next sort of 6-7 weeks or so, we must be able to get some positive growth against declines of approaching sort of 30% from the same time last year. And then it's going to get a bit tougher. So you can see the problem for the year, can't you? So just to show you a few categories then to break that down. So this is how it's all done. This is quite a familiar sort of pattern that we tend to see week after week, quite a few declining, and then there's a few that have sort of done all right. But these declines aren't too bad, but you have to put it into context that Q1 last year was some quite big declines following sky high growth in Q1 2021. So health and beauty is having a bit of a strange time where some of its subcategories are doing pretty well and then others are maybe not doing so well. So makeup, fantastic growth there, but then toiletries and fragrance, etc., not very good. So actually health and beauty came in at just slightly negative. But home and electrical were both up, which is pretty good. And when they do well, because they're quite high spend, it does kind of mean that the overall market, the overall spend is kind of pulled up a little bit. But look at clothing, for example, which is somewhere in the middle there. That's having a slightly more torrid time at the minute. And then what I thought I'd do is just take you through a few of these categories in a little bit more detail to show how they're going. So the first one to show you is electricals. And yes, positive growth, right? So it's definitely not to be sniffed at. And it's been kind of flattish as well for a few weeks before that as well. So electricals is comparing though against, so the grey line is 2022 across that period of 6 weeks there, leading up to the latest week that we've got. And 2021 is the blue line for comparison, right? So when you look at that, it is against declines of sort of 33% from last year. So it's growth, not to be sniffed at, but it is against a very strong decline from last year. But electricals, just ballooned in 2022, had a huge growth online. So some of that stuff is falling away, but it is sneaking into positive. But you have to contextualize it. And then clothing is the next one to show you. And clothing is slightly in a slightly worrying position, I would say, because clothing didn't have that big boom in 2020 that a lot of the categories got. So it's just had a different sort of journey, sorry to use that term, from that place to now. But it did mean that in 2022 it was actually had some quite good periods. So if you look in the middle there, this is 12 months that you're looking at here. In the middle, it had growth of sort of 15 to 20% at times. Really good growth. And then it was hardly ever into negative territory across the spring and summer. But just in the last sort of 8 weeks or so, it's actually been in negative quite a bit. So that kind of surge in volume that it was getting in mid-year just seems to have run out of steam a little bit for the clothing category. So it's proving immune to the downturn some of the others were getting, but maybe it's not. And then home and garden is doing something a little bit different from quite a few of these other ones, actually. So it did have some spectacular declines in 2022, and overall the category was down something like 17% for the year as a whole. But look at that Q1; it really was 40% down for quite a long time. So the declines were really strong. But then it has been in largely in positive territory for quite a few months now. But if you break it down into the categories of it, it's actually furniture that's doing well, and the other ones are not doing terribly well. But furniture has got a hell of a lot more expensive. The basket value has really shot up in furniture. So, it's positive nonetheless. And then health and beauty, which was sort of talked about a little bit earlier, where the subcategories are proving a little inconsistent. So sometimes like makeup was the one that did really well last week, but then the other categories were all negative. So it's not done well overall, but very sort of bitty performance over the last 6 months or so. It's been, sometimes into positive and then falling away into negative. So quite a consistently inconsistent story for health and beauty there. And then the next thing to show you is traffic. And, I'm sorry to show this one really, because this was in 2022, the sort of bright spot that I would often pick out. So this is showing growth in traffic to online retail sites for the last 12, 13 months. So that goes back to the start of January 2022. I'm still getting used to the years, you see. So, big declines, as you see, with the revenue for Q1 for obvious reasons. But then it was, not spectacular. It was sort of low single digit growth, but quite often into positive across summer and autumn. So that's, that's good. But then it kind of has had a slightly difficult time really in the last month or two, where that traffic has fallen away. And the last two dots, right hand side, are the first 2 weeks of January, and they're compared against the first two dots on this chart, which is January 2022. So it was negative last year, negative this year. So that is a bit of a shame, I think. And then to show you conversion. So even though the traffic has been, so that is conversion, ignore that label. I always get one chart where I forget to relabel it. So this is conversion rate on websites. This is a 2-year period you're looking at here. So if you draw a line right down the middle, that is 2020, well, blimey, we'll get in here. 2021 on the left-hand side, 2022 on the right-hand side there. And so yes, traffic has kind of did okay for periods of 2022. There was a little bit of growth, but the conversion has fallen away. So look at where it was in 2021, and then it's kind of markedly down for most of the year and really quite flat as well, and not quite as responsive as you would hope it would be when you're running certain campaigns and things. And then that kind of spike where it jumps up is Black Friday and moving into December, getting close to Christmas, when people do press the panic button because they've forgotten to buy something for someone. But then it's just dropped straight back down to where it was. So it seems like very reliably, you're looking at about sort of 2.93% conversion for overall. So is that just kind of stuck where it is now? Maybe, we don't know. So that is a view of the first week of January, generally how the market is doing. I'm going to show you some stuff about splits between budget and mid-tier premium in a little bit, but we're going to just talk about the channel here. So we'd like to jump around a little bit and bring you all sorts of stuff pertinent to e-com. And the channel we're going to talk about today is direct mail. So Ben is from Epsilon Abacus. Ben, what is Epsilon Abacus?
What is Epsilon Abacus? Good question. Hi, everyone. Thanks, Andy, for having us back on again. It's good to be back on one of these data shows. We are part of Epsilon, the data business that sits now at the core of the Publicis Group's data offering. I'm sure all of you have heard of Publicis, and I'm sure many people here will have heard on previous data shows about what Epsilon can do on the digital side of things. The Abacus part of the business helps e-commerce retailers to target prospective and lapsed customer audiences, specifically through the direct mail channel.
Okay, so just to clear up then, what do you mean when you say direct mail?
Yeah, and I think that's a good question, because I think a lot of people have ideas in their head and it might not necessarily be exactly what direct mail actually looks like today, because obviously it's been around a long time. So, you know, certainly in some cases, it could be considered a little bit old school, but its appearance and its role has really changed in recent years. So essentially, it is a printed marketing piece targeted to the individual. So you have a full name and address on the mailing piece. The formats can vary. So those sort of days of perhaps the old school direct mail idea of those big thick catalogues are gone. But catalogues still exist as a format, but they tend to be much slimmer, particularly for acquisition, where you're mailing to existing customers. You can afford for them to be a bit thicker because, obvious reasons, those customers will be more familiar, but also letter and envelope formats, or roll fold, which basically is a piece of card that folds multiple times, so you can fold out and you have more sort of real estate to talk about what you do and share your products. So there's a variety of different formats, but whatever format it is that particular retailers are using, they are using them to drive online sales. So fundamentally now, whether it's to prospective, existing and or lapsed customer audiences, the offline mailing piece is encouraging people to go to the website and make a purchase.
Mm-hmm. I'm glad you said the thing about it's, you know, maybe considered a little old school and stuff, because that's kind of what I wanted to say as well. And I wonder, but you know, it's one of those things where it still is a really big thing, isn't it? You still get loads of this stuff through your letterbox. But who does it like work for? Are there certain types of, you know, brand or company or whatever that are more likely to use it?
Yeah, there are. There's definitely a sort of a type of business, and also a kind of a growth stage where this tends to start to be something that marketers will look at. So basically, businesses that are at the stage of growth where they're looking at incremental growth channels over and above their digital acquisition spend. So Facebook, Google, you've got all of that working. It could be new investment. It could be that you're starting to see the performance of your digital activity plateau. So you need to try and find the sort of next jump up in terms of incremental growth. Or it could be just diversification of channel mix, for example, to even out the impact of algorithm changes, which we all know about, or whether it's in preparation for the upcoming third-party cookie deprecation, whatever it might be. And then I think the types of business that it tends to work best for, and certainly where we have probably the most clients, is e-com retailers that are in the fashion space, homeware, furniture, gardening, gifting, health and beauty, groceries, meal boxes, starting to see more from travel now. And also in terms of the sort of type of retailer, it works very well indeed for subscription brands as a means of recruiting kind of VIP subscribers, those people that are going to go on to order that number of times for which a subscription business finds that those customers then end up being profitable.
Okay, and then just in terms of how it works as a acquisition channel, then, you know, because I think the impression that you get of direct mail is person walks around with leaflets, puts through every door. You know, irrespective of who they are or whatever, unless they've got the, you know, don't post through this letterbox sign up, which probably gets ignored. But how do you sort of go about identifying the right audience for it and stuff?
Yeah, so I suppose the first thing to say is that direct mail works best in conjunction with other channels. So when you are running a direct mail campaign, the best time to do it is when you've got other marketing going on. It works best as sort of part of a marketing mix. The best way to select the audience is by using transaction data. So historically, audiences used to be selected by swapping or renting customer lists in the marketplace. You see very little of that these days, and largely that's because of the advent of data cooperatives, of which the Abacus Alliance, which is the Epsilon Abacus data product, is the market leader in the UK. And basically what that is a single customer view of what millions of households across the UK buy across hundreds of direct-to-consumer retailers. And using propensity models to find lookalikes of your best customers based on all of that transactional activity elsewhere in the market will find you the most responsive prospect audiences. And I think particularly when times are tight, and it's very important to find those that are fortunate enough to position to be able to spend at the moment, then using transaction data is kind of ever more important. And also it's worth highlighting when you're talking about audience selection that you can also guarantee with direct mail that you are only reaching net new prospects if it's customer acquisition that you're using it for. Epsilon and indeed other data providers, I'm sure, but we will always suppress our clients' existing customer database from the prospect audiences. So this is very helpful in comparison to, the other print channels that people might be familiar with, inserts and door drops, for example, where you can't avoid crossover with some of your existing customers. And that sort of audience selection works the same way, whether it's prospect audiences that you're targeting, so customer acquisition, or whether it's lapsed customer reactivation as well. So I think if you're looking at it from that perspective, because of the cut through with direct mail, it's a very effective way to win back customers that maybe haven't bought for 12 months or more. But direct mail is an expensive channel. You've got to pay for the print and the postage. It's going to be a higher CPA channel as well if you're using it for acquisition. So you need to know which lapsed customers are most likely to buy again. And so as with the prospect audiences, the best way to do this is to find lookalike audiences using propensity modeling based on transactional spend across the market. And then you can identify those people that are worth sending the direct mail piece to, i.e. those that are most likely to be in a position to buy from you again.
And if there's someone who is kind of, is a customer, etc., they're already doing stuff with you, and what's the purpose of sending them something when they're already, I don't know, a bit engaged?
Yeah, that's a great question, because so often when people come and talk to us about starting out with direct mail and kind of building that into their mix, it is with acquisition in mind. And we'll ask the question, okay, I assume you're, planning to mail your own customers as well? And they say, well, no, not really. And generally the feedback is that you think, well, these people are going to buy from us anyway, so why would we, invest further marketing budget in talking to them? So very simply, the reason for mailing your existing customers, and by existing, I guess here I'm talking about people that are what you would class as your active customers. The reason to mail them is it encourages them to put more in their basket, first and foremost, because of the real estate that you've got with direct mail formats, even the shorter formats, but certainly with something like a catalogue, you're able to convey more of your products and perhaps a sort of broader range of products. This Works, for example, so long-standing client of ours, everyone I think that I've ever spoken to knows their lavender pillow sleep spray. But their branding is based on a 24-hour clock. And so what they find with their catalog is that they're able to recruit their VIP customers. And the reason that they can do that is because they can talk about the 24-hour story, and they can get customers bought into the different product ranges and get customers buying across the different product ranges. So mailing your own customers can get them to put more in their basket. It can encourage them to come back and buy from you more frequently. And the key thing with this, if you want to test incrementality, it's incredibly easy to do, because you just include a control group in the campaign that doesn't receive the mailing. And then you can very easily justify to yourself, was the uplift worth it? And in 99% of cases, it will be.
All right. And if people want to find out more, what can they do?
That is a timely question. We are actually hosting our first face-to-face direct mail masterclass for 3 years. We've been running these for 8 years, but we've obviously had to go online the last couple. Tuesday, the 31st of January at the Soho Hotel. It is a free morning event, breakfast and lunch provided. Basically, if you are thinking about direct mail and wanting to bring it into your mix or wanting to identify ways to improve the direct mail activity you already do, this is focused on a bit of a direct mail 101, how to get it right across creative, data, print and postage. We'll have a panel of people that have been there and done it and sort of, been newbies 2 or 3 years ago and now have stories to tell. I think Tom has put the link in the chat function. So if anyone wants to sign up for a free ticket, you can just head there.
Okay, great. Thanks a lot, Ben.
Thanks, Andy.
So time to talk about budget, mid-tier and premium retail. So what I showed you early on was all the retailers in our index combined. There's about 200 of them. And what we can do is apply filters. So they're all tagged up in a certain way. So we know which retailers are budget, which ones are mid-tier and which ones are premium. And there's a bit of a process we have to go through to decide whether someone's premium or mid-tier or whatever. And there, there is a bit of jiggery pokery we have to do to work that out. But part of it is based on the basket value. Part of it is based on what we think they are. Sometimes we ask them what they think they are as well, and then we try to come to a conclusion. Some people are really obvious, some people are a little less obvious. So, but we get there in the end. So what you see with this first graph is just the budget retailers. Okay, so we've applied. You're looking at revenue again. So this is online revenue. This is the past 12, going back to the start of January 2022, so about 12 months. And you're looking at just the budget retailers in that index, right? So just their performance. And what you see is, you always get this familiar drop at the beginning of the year where it was lockdown affected, etc. They're all like that. But then how did they get on once we got into the period of sort of May onwards, when the year on year became reasonable that you could have grown against? And this is how budget looks, right? So it has actually sneaked up into positive territory. So it's not spectacular, but just in the last, I don't know, sort of 10, 11 weeks or so, you've probably got nearly half of them have been into positive territory, right? So that doesn't sound too bad, does it? And then if we look at mid-market, this is what it looks like. And so that same thing where it's, a big drop in Q1, but then it sort of did pretty well in the middle of the year. It was doing quite a lot better actually than the other ones. But then since then, it has actually sort of tailed off a little bit, and it's become one that has actually been quite firmly into negative territory, a lot more than positive, particularly recently. So mid-market, you could argue, seems to be getting a little bit squeezed there. And then premium retailers look a bit like this. So again, it's not fantastic really for them. They've had a little bit of growth here and there, but nothing really consistent, and some quite strong declines, I think, if we're being completely honest as well. Now that's as you may expect it to be, but if we just put them all together, and I apologize for this chart, this is a total mess to look at, but that is your 3 lines there. So you've got the orange line is the mid-market ones, budget is blue, and premium is grey. So it's the same you're just looking at. I've just squashed them onto the same chart here. And the interesting thing is, where that big red box is, so we looked at this, 4 or 5 months ago or something like that. And really the story was that mid-market was kind of doing pretty well. So it was the budget and the premium who were kind of struggling for growth a little bit, and mid-market seems to be a little bit protected. And I think there seems to perhaps have been a slight change in how people are doing stuff. So we have to understand is that our index is general merchandise largely. There is beers, wines and spirits as well, but we don't have grocery in it. Now, grocery is obviously a very big part of overall retail. And if the way that people have been spending on grocery is that they've tended to, a lot of the supermarkets have reported that people have sort of gone down a little bit. So they've sort of reduced their spend. They've gone to own brand products and things like that, rather than the expensive one, just to save a few quid here and there, as you may expect. But with the general merchandise, it was a bit more of a complex picture. It wasn't necessarily, I'm just going to go for the cheapest thing that I can get. For a while, people were still buying sort of reasonable quality. They just weren't buying as many of those things. So they're trying to buy something that's going to last a bit longer and stuff like that. So it's a slightly different mentality. But as time's gone by, it does seem that budget has actually started to do better, and the mid-market's been a bit squeezed. So maybe we have reverted now to something that looks a bit more like you might have anticipated it would look like when you think about squeeze on customer spend. Another thing that we can look at with this is the average basket value. So again, this is just the budget retailers that you're looking at here, and what is the average spend? And this is a 2-year view that you see here. So again, if you put a line right down the middle, that's effectively going to give you 2021 on the left-hand side, 2022 on the right-hand side. And though it's just a bit of a sort of horizontal scattergun, really, isn't it? There's not massive amount of change that goes on in it all the way over that period. The difference is it hasn't been immune to inflation, etc. It's just difficult to see here, but really, if it was about £50 on average in 2021, it's more like 55 plus now. So an increase of about 10% or so. Feels about right, doesn't it, for inflation? So it has gone up a bit, but the pattern is broadly the same. One thing that I would point out, though, is look at that red box where I've put. So that is covering November and December. So for budget, it went up. The amount of money spent went up, even if there is discounting and stuff going on, people bundling things up in 2021, and that didn't happen this year, which is pretty interesting when you think about it. So mid-market is the next one we'll see, and this one, I think there's a very notable sort of pattern that's happened here. So again, it's that 2-year view, and with mid-market, it done half jump around quite a lot. So we have seen difference in basket value across the year because of inflation, etc. But it just seems to be one of those categories where it just jumps up and down quite a lot. And I would suggest that perhaps that's because in the mid-market, maybe that's the bit where discounting is a bit more of a big deal, right? So if you're going to budget, then things are cheap anyway. Premium don't want to discount too much because it's not really what their brand is about. But in the mid-tier, that's perhaps where, you stick on a sale 30% off this weekend or whatever, and it actually makes a bit of a difference, and people kind of respond to it. So maybe that's a bit of that jumping around. But then look at what's happened since sort of July, August time. Remember that mid-market has been getting squeezed a bit. That jumping around has kind of stopped. So over that period where it started to not do quite as well, maybe people are not being quite as responsive to stuff like that now. Those jumps have really, really flattened out. Premium is the next one, and premium's quite as interesting a story, really, but it's similar kind of thing, really. It sort of flattened out a little bit, I suspect. But that was the first half of the year compared to last year, so the jumps are not quite the same. But really, it's gone up, really. The spend has gone up. It's not quite as interesting as the other two, really. But that's what I would suggest, really, is that the mid-market is showing like a bit of a change just over the last sort of 4 and 5 months or so. And then the final bit here is just to show you the some mid-tiers. But this is by category. So this is clothing, which is a yellow line, gifts is light blue, and health and beauty is the purple one. And this is running from June 2022 through to January 2023. So that's that period we're kind of looking at where there's been a little bit of a change. And it looks like the pattern is true for clothing and for gifts. So they were kind of, gifts was negative, don't get me wrong, but it fell away further over that period, and then clothing was kind of doing okay, and that's come down a bit as well. And then health and beauty just seems to be like a little bit more of a basket case with its growth across however much you filter this stuff. Yeah, so that's the view. I think we've had a little bit of a change there, and it's now performing a little bit like you might have thought the blooming thing would in the first place. So time to get a few guest perspectives then on expectations for 2023 before Matthew comes in and slays us all with some figures. You might have in your mind already, of course, what you think that figure is, and let's just hold it in your mind. Maybe write down a bit of paper in front of you, and then we'll show you what we think in a minute. Scott, hello. Do you want to get us kicked off?
Yeah, sure. Hi, I'm Scott. I am the head of digital strategy at Query Quick. We're a performance marketing agency based across the whole of the UK.
Marvellous. Lawrence.
Hi, everyone. Hi, Andy. So I'm Lawrence. I'm from Bright Cove, and we work with brands to power their online video. Everything from Olympic broadcasts with millions of viewers through a streaming platform, to retail brands with product videos and live shopping. I focus on retail customers based in EMEA, which includes several national and global high street and luxury brands. And I talk to my clients about their e-commerce sites, specifically how their content and video strategy can positively impact conversion and engagement. And today I hope to touch on a few trends I'm seeing with my clients and the wider market, and try and offer some practical tips on what I think brands should be thinking about.
What we'd like to hear, Bobby.
Hi, everyone. My name is Bobby Tulis. I'm Group Marketing Director for GFS. For those of you that don't know us, GFS is the e-commerce industry's largest provider of managed parcel services. So we take care of delivery and returns for most of the retailers, both in the UK and internationally.
Magic. Right. So this is a very straightforward panel, really. We just want to get some ideas from you as to what you think will be interesting things in 2023. Whatever what you think will be, this is definitely something that will happen, or just some bit of guidance, bit of advice or whatever. So Scott, from your side of the world, what do you think?
Yeah, from our side of things, it's looking at the challenge of kind of cost-effective new customer acquisition. Obviously, as the market is proving to be increasingly turbulent, as you've just kind of gone through, brands need to find new customers, but they need to do so in a manner that is not going to break the bank, essentially. And one of the real key challenges that we've seen in the marketplace over the last couple of years, but especially looking at 2022 versus 2021, is the rising cost of CPCs and CPMs when it comes to actually trying to attract those customers. So taking a look at a couple of our retail customers, one in the outdoor industry and one in the health and beauty industry, they actually saw CPCs rise by 71% and 92% respectively year over year, meaning nearly twice as expensive per click.
What time frame is that, Scott?
That's over the course of the whole of 2022 versus the whole of 2021 on average. So from the end of 2021, we were sort of around about 20p for some instances. It was off as high as nearly 40 pence on average for some of those health and beauty clicks, and that's in the non-branded space as well. So that is really where your customers are in their kind of awareness consideration phases of their journey. They're looking for products. They don't know exactly who they want yet. They're not yet deciding which brand they're purchasing from. So that's really where the new customers lie, but it just shows you it's really, really expensive in that space to be able to target. And one of the core challenges there is making sure you do that effectively. Obviously, marketing budgets in time of recession and things like that ought to often get squeezed. So actually, you're putting more and more pressure on your performance marketing teams and agencies to try and find those customers as effectively as possible. Part of the kind of way to try to help really improve that is also thinking about what are the long-term sustainable marketing channels that you can use in order to actually drive that new customer acquisition without the need to kind of go to the paid well all the time. Now that's where your kind of organic search and your SEO activity really does become kind of fundamental for your long-term focus as a business. I think quite often paid media is seen as a nice quick fix to kind of boost performance, get those kind of quick wins. But when that budget isn't there, that long-term SEO side of things is really, really key. And we have a guide, which I think Tom might be able to put into the chat with us, which takes a look around your sort of SEO maturity guide and really understanding where you are on that journey. Because as I mentioned, it's quite often it's been slightly overlooked, but really now is a time for brands to start looking at how do they get the most out of their organic search so that they have that long-term stable ability to drive customer acquisition without the reliance on paid.
Okay, just one follow-up question there. What about what are the factors? So spectacular increases in the cost. Why?
A couple of reasons, really. So firstly, we've actually seen demand reduce quite a bit throughout the course of 22 versus sort of other years. What that means is less people are searching, obviously, but no less competitors are bidding within that marketplace. So essentially, the number of people you're looking for is fewer, but the same number of people looking for it. So that drives up the auction cost essentially within these platforms, which means you're paying a lot more for the fewer customers because it's become a little bit of a race to get them, as opposed to when they are kind of very numerous, they're slightly cheaper to gain. Some of it's also down to the platforms themselves. So increasingly we've seen, and it was touched upon earlier around things like the cookie list moving away from cookies and things like that, the lack of control that is starting to eke into some of these paid media channels where you are not able to be as granular as you once were, which does mean you're having to cast that net a little bit broader, a little bit less control. It's driving up the CPCs because you're potentially not quite as relevant for some of the people that you're trying to get in front to. And that is a real challenge for performance marketers right now, to make sure that you're getting in front of the right people and as much as possible. And I think that's going to be a challenge that continues into the kind of post-cookie world that we're entering into in sort of 2024 and beyond.
Okay. Lawrence, how about you for 2023?
Yeah, so it's good to come straight after Scott, because I think what he was saying was, what are the problems retailers are facing when driving traffic to their own website? But once they're there, you want them to convert, you want them to have a look around, make sales, and you want them to come back as well. So it's really about that retention as well. Customer expectations are changing. People want a more personalized service. So the customers that I work with have been talking to me about how can they really tailor and improve the customer experience to the individual customer. So where they've got thousands of product SKUs, the average customer isn't going to look through every single one of them. They want to be able to find either quickly what they're looking for using the search nav on the website, or your kind of navigation experience throughout. Or they want to be inspired. It's product discovery. And one of the big components of that is understanding your customer. There's been a lot of talk of first-party data because some of the challenges to do with privacy these days. And a really vital component of that is video data. This is something that marketers can use to assess the engagement they're getting with the captive audience on their website. And it can give you another angle on top of page analytics. So you can know how many people are on a particular page, but if you've got multiple videos on a page, perhaps like a product listing page, the viewer level analytics can give you an idea of, okay, is someone watching this video or that video? How long are they watching for? And that brings me into another area, which is AI. So there's a lot of kind of hype about this at the moment. I think I watched the last talk last week, and someone was talking about ChatGPT. So these are some really prevalent examples at the moment. But really within this retail e-commerce context, AI can be used for things like understanding what is actually in the video. So kind of automating that process where there are thousands of product SKUs. So we have some technology that can automate captions, for example, and something we're going to be looking at in the future is understanding visually what's in a video, which can then help marketers to categorize those videos. So if a viewer has seen 3 videos on red dresses, for example, then that can then connect with our technology back into a marketing automation platform that can lead to targeted email campaigns, and also things like personalizing the web experience. So when they log back in, it will surface red dresses, for example, because that's some of the video content you watched last time. So yeah, it's really about that personalization and how AI can kind of help with that and take a bit of the legwork out of it.
Are there any sort of shifts going on in how people are using the content in their videos, how retailers are using that stuff? Is there any like trends or any differences that are going on?
Yeah, so I think it's important to note that as well as the kind of tough economic times, retailers are really trying to watch their bottom line, and they're trying to, kind of maximize their resources where they can. And content creation is really expensive, especially if you're doing video content and you're recording product videos for all of your products. Let's take a fashion example. I would say in that scenario, things like jeans and dresses actually do really well with video, because the average consumer wants to see how they fit. It's not good enough just, for example, on a t-shirt where you can do small, medium, large. They want to see on a model how that's looking. So that's one way that consumers find it incredibly useful to have a video. But then also retailers can really prioritize the resources they have and focus on those products, as well as perhaps items that have a bit more margin on them to help their bottom line. And then also when it comes down to kind of really connecting with the audience, retailers are also asking a lot about live shopping. We've seen lots of examples of that. Obviously, Instagram is a really popular way, TikTok, that sort of thing. But having that on your own website or on your own app, you get all of that first party data. And you can also cross-sell with other products and things like that. People get really easily distracted by clicking on different videos on those other platforms that might be by other brands. So it's really easy for those consumers to kind of leak off to other platforms. So that's the kind of thing that that helps differentiate brands from other brands, and how retailers can kind of maximize their video content strategy.
Okay. Bobby, so slightly different perspective here, looking at delivery and returns really. But we're going to show you the figures in just a minute. But spoiler alert, we're not saying it's going to be fantastic. So what does that mean for what's going to happen around delivery and returns?
Well, I think we all agree that the outlook for 23 is going to be another tough year for e-commerce. And much like Scott and Lawrence have already said, we expect retailers are going to be having a really tight, being focused very firmly on the bottom line and protecting their margins. So protecting profit margin is going to be really key. Looking for ways where they can be reducing costs and improving operational efficiency around delivery and returns is going to be really key. So the big ones would be, for example, reviewing what their current mix of services and carriers are, to ask, are they still, are you still getting the best price, the best bang for buck in terms of price, performance, choice of services that you can offer to your consumers? Do you have the flexibility to move parcel volumes between carriers and services if the need arises, whether it's because you can get a better price performance by making that change, or whether you need to make that change because you need contingency? So reviewing the carrier mix is one of the big ones. But the obvious one is obviously rethinking the policies around free delivery and free returns. We know, I think Scott talked about the cost per click, how that's gone up, enormously over the last year. I think in our world, if we look at fuel surcharges, last year the average monthly fuel surcharge on road transport was 38%, compared to what it was the previous year when it was around 18 to 20%. So the cost of delivery, cost of returns is really hitting the bottom line. Now's a great time for retailers to start rethinking that and resetting consumer expectations around that. Consumers are hypersensitive and hyper aware of costs right now. So it's not going to come as a surprise to them if retailers start charging for some things. We saw Zara and Next, introduce that last year. And more recently, AO World introduced charges for some of their deliveries over peak. And it didn't seem to phase their customers in the, the last quarter for them, sales performance exceeded forecast. So I would say that now really is the time to be looking at the bottom line and looking at where you can find cost savings and operational efficiencies, specifically around delivery and returns.
Tricky one, isn't it, with this this returns bit though, isn't it? I mean, so if you do start charging for it, and then you weren't previously, did you have any kind of insight into how people have kind of changed things like that, and the sort of impact that it's had?
I'm not saying that people are going to, suddenly remove free and start charging for everything. We're seeing, I think the trend we'll see is that retailers are going to be taking a more considered approach around their policies and using free delivery, free returns as a way to either incentivize purchase or disincentivize some of the bad behaviors we see with people, ordering 6 pairs of shoes, knowing that they're going to return 5, they're only going to keep 1. So I can give LK Bennett as an example, one of our customers. They've started charging for returns, but only on discounted sales items, items that are going to be harder for them to turn around and shift once they're back. So it's not about making a profit out of delivery and returns. It's really about covering your costs, because the priority here is protecting your profit margins.
Okay. Yeah. All right, well, thanks very much for your insight there. I hope you got something out of that, folks. We're going to put that thing in the chat, by the way, that SEO guide, shortly. But it's time, I think, to show you the numbers. And when it comes to showing you the numbers, there's only one man with the capability for such extraordinary gifts for things. Matthew Walsh.
Hello, thank you for that rather kind introduction. I have a calculator glued to my hand most of the time. So hello to everybody. I work for IMRG. I'm the data guy there, looks after all of the market tracking. And over the past couple of weeks, I have been busily working away on a forecast for what we think is going to happen this year. So for the next kind of 10-15 minutes or so, we're actually going to share with you how we came up with that number and actually what that number is. So it's probably quite useful, actually, before we start diving into 2023 forecast, to actually look at 2022 and the forecast that IMRG put out 12 months ago, i.e., can you trust us? Do we actually know what we're doing? A quick comparison of what we said was going to happen last year against what actually happened. So when we do a forecast, we come up with kind of a good, a bad, and an average scenario. The average is what we kind of think is going to happen. It's the predicted line, of course. And then there's a little buffer. If it's good, it'll go up to the good forecast. If the market is bad, it kind of goes down. This is what we said we thought was going to happen across 2022. So the expected number for the total market, every category combined, across the 12 months of 2022 against 2021, we thought it would be around about -7.2. But it probably isn't news to anybody, but last year wasn't that great. It was actually pretty bad, and it followed the poor line rather well. The actual performance for last year was -10.5%. So very, very close to what we thought was going to happen under that poor scenario. So that's not bad in terms of forecasting, given all the chaos that happened last year, all the market turmoil and all of the problems that are going on around the world. Less than 0.5% out isn't that bad in terms of a forecast. So let's press on and take a little look at 2023. So before we kind of share the numbers with you of what we've calculated, I think it's quite useful just to spend 5 minutes looking at how we've actually come up with that number and all of the features and considerations that have gone into that calculation. So here is a list, and in no particular order, the things that we used to come up with our forecast. The first is historic performance, obviously. Whenever you are looking to do any kind of forecast, using historic trends, historic numbers and data is a fantastic way to predict the future. The problem, however, is that the last 24 months of online retail has been a bit chaotic. COVID, cost of living crisis, peaks and troughs across the whole of the market. So there isn't this lovely, nice, smooth trend that you can normally rely on. So historic performance was considered, but it wasn't massively helpful in the last few years. COVID annualizations are now gone. So any kind of lockdown period that might have happened for online trading has now disappeared out of any year-on-year comparisons, which is great news for predicting what future might look like. Cost of living crisis, so it's not all about what's going on in our database and our numbers, it is also these macroeconomic factors. And the cost of living and energy prices is probably top of that list as to factors that are going to restrict people's spend online. High street performance is an important one as well. Take December, for example. That happened to do very well on the high street. Lots of people decided to go out and buy their Christmas presents in physical shops because they couldn't rely on the delivery aspects during that crunch time to Christmas because there were postal strikes. Inflationary pressures is another thing. Inflation is over 10% at the moment. The Bank of England's target is 2%. For researching this forecast, we read lots and lots of different articles online and think tanks and pension funds, all of their predictions for what this year might be. And there is a good consensus that inflation should start to decrease kind of from mid this year and should actually come down rather steeply as well. So that has been considered into the forecasting. The war in Ukraine, we are not experts on military warfare, but it does currently look like there is no immediate end to the war that is going on. So it's quite a consistent factor to consider when we are looking at forecasting for this year. Interest rates, they are at kind of a high of over a decade at the moment. That is restricting people's spend. Every month, over 100,000 people are coming off of their fixed rate mortgages and being lobbed onto these kind of standard rates that are considerably higher, reducing people's disposable income and in turn, what they are likely to go and spend in the shops. So as I said, lots of these economic predictions, we took the insights from investment banks, pension funds, or what they are considering as the movement across the markets over the next year. Strikes is a consideration. You can't open a newspaper at the moment without the thought of strikes. Again, that kind of plays quite nicely into the idea of the high street performance, particularly if those strikes are related to postal services. And lastly, but not least, is the second half of 2022. So this kind of ties in quite closely to the first point, this historic performance of the UK market. The second half of 2022 is actually a really good indication as to what the rest of 2023 is going to do. Namely because all of these aspects that have just been highlighted that were present during the last 6 months of 2022 are highly likely to continue on through for 2023. So you have a situation where all of the macroeconomic factors that were pushing down or affecting the market in some way, we've already seen what that looks like to be doing to the market over the back end of last year. So that acts as a pretty good model for what might happen for the next 12 months. So let's take a little look at what actually happened over the last year. That is all the major product categories that IMRG track. And it is the 12 months across 2022. Black line is the total market. So that's all of those colors combined and aggregated into one. It's quite interesting, really, when you highlight the second half of the year, that clothing in yellow there, by the end of the year, it does join the rest of the party. Everybody is kind of heading towards the same direction, and they are within a very narrow band of performance. All the colors move roughly in the same way, and they all had a pretty bad December. And you're looking at somewhere between 0 and minus 10%. Interestingly, they are all, if you actually look at it, moving in a upwards and to the right-hand side trajectory. Until you got to December, which had the strike issues, they were all moving towards that 0 line, which could indicate as to what we are expecting for the next year. So to take last year's numbers as a whole is slightly misleading. It's best to actually look at the second half of the year. So to summarize that into actually specific numbers for you to show what last year looked like, this is all of those categories across the 12 months, but next to each one is what happened over the last 6 months of the year. Now, those numbers there played a very important role in our forecasting for this year. The lighter shade next to each of those product sectors played a heavy role in where we thought this year is going to go. So where do we think this year is going to go? Let's get to the actual number that you want to see, ladies and gentlemen. This chart is going to show you the first 12 months of 2022, the whole year. That is the actual performance of what happened. And we're now going to show you our expected line, the one in the middle, of what is going to happen across 2023. That is the line we think. It's pretty much going to hover around the 4 or 5 or 6% of negative decline year on year. And then as we get to the very end of the year, the peak months, there is a good opportunity for it actually to reach 0 or even positive growth. December 2022, where my mouse is now, was a shocker. So the potential to grow on top of that is actually quite good, but you've got a huge amount of market pressures actually suppressing it to get into positive growth for pretty much the whole year. The good and poor scenarios look like this. Please do note that we think the scenario is not an exact kind of plus or minus 2 or 3% all along the year. Indeed, if it goes bad, we think it's going to go more bad than if it goes good. So you can see the final few months, that yellow line is closer to the green than it is the red, simply because if we think it's going to go quite bad, it could go severely bad. So the overall number, if you total that up across a whole year, this is our exact forecast. The number in the middle is the one that you're going to care about, minus 3% year on year. That is what we are forecasting. There's been a whole amount of math going into this. We've done lots of modeling, lots of numbers, lots of spreadsheets, and then we layered in all of that macroeconomic factors that you saw as well. So it's a nice combination of pure science and math and actual kind of considerations of the wider economic considerations. And in terms of product categories, we have done that as well. We went into each product category, the major areas that we track, to see how those have done and what we thought could potentially be their expected route for 2023. And they look like this. Clothing manages to keep itself flat. It had a pretty good year last year, but it is starting to come down and kind of sit on that 0 line. Everything else is going to be sitting between 4, 5, 6, 7% year-on-year decline. So normally I come on here on this show and try to present some positivity and some happy light to the market results. But I am afraid it does look like it's going to be a bit of a tough year for online trading. And bear in mind that these numbers are what we predict for the aggregated view of everybody in our panel, the entire market, that is. There is certainly opportunity for individual retailers to get positive growth. We are certainly not saying that everybody is going to do negative. I guess the trick is to make sure that you are one of those few that manages to get positive growth. But with that, I will hand back to Andy. Thank you very much for watching.
Okay, there you have it then, folks. Sorry we didn't have better news for you. You never know, maybe we'll get egg on our face and it will be +20. So next week, same time, same place, 2 to 3 o'clock, we're doing another little look. So we'll do the same thing that we do, where we look at what's going on, how the market is currently performing, but we'll also have a slightly qualitative look at what we think is going to happen in 2023 as well. So I hope you can join us for that. Thank you for listening and see you next week.